Welcome to our session on investment analysis and taxation of income properties. Today, we'll explore how to evaluate the profitability of income-generating properties and understand the tax implications that come with them. This foundation will help you make informed decisions and optimize your investments. Let's dive in. When we talk about income property analysis, it's really about understanding why this process matters so much. First, it helps with risk assessment. By analyzing a property thoroughly, we can identify potential risks and determine if the investment is viable. Next, it's about return optimization. This means maximizing your profits by carefully evaluating how the property can generate income over time. Finally, tax efficiency plays a big role. A good analysis helps you plan in a way that minimizes tax liabilities and increases overall returns. Ultimately, a solid analysis transforms buying a property from just a simple transaction into a well thought out, disciplined investment decision. This approach is key to smarter, more successful investing in income properties. Here, we're focusing on one of the most critical metrics for real estate investors: cash flow. Gross rental income is the total rent you collect from your property before any expenses. From that, you subtract your operating expenses, things like maintenance, property management, taxes, and insurance. What you're left with is your net cash flow. This number is essential because it shows whether your property is truly profitable on a monthly basis. Positive cash flow means a property not only covers all its expenses, but also puts money in your pocket. This is the investor's clearest reality check. If your cash flow is positive, your investment is working for you. Understanding and monitoring this metric helps you make informed decisions about your property and overall portfolio. Now, let's dive into understanding the cap rate, which is a crucial concept in real estate investing. Simply put, the cap rate is calculated by dividing the net operating income, or NOI, by the property value. This ratio gives you a quick snapshot of the potential return on an income-producing property. A higher cap rate typically suggests a higher return, but often comes with greater risk as well. It's a fast and effective way to compare different properties across markets and make informed investment decisions. This concept is key when analyzing investments and considering the taxation implications of income properties. Now, let's talk about the cash-on-cash return, which is an important metric in real estate investing. Essentially, it measures how hard your actual cash is working for you. To calculate it, you take your annual pre-tax cash flow and divide it by the total cash you invested in the property. For example, if your annual cash flow is $12,000 and you initially invested $100,000 in cash, you divide $12,000 by $100,000, which gives you 12%. This means you're earning a 12% return on the cash you put in before taxes. It's a simple but effective way to gauge the performance of your investment and see how much income your cash is actually generating. Here, we're looking at the three primary methods used for property valuation. First, the income approach. This method values a property based on its expected net income and the return investors require. It's especially effective for income-producing assets like rental buildings or commercial spaces. Next is the sales comparison approach. This method estimates value by comparing recent sales of similar properties and making adjustments for differences. It's most reliable when there are strong market comparables available. Lastly, we have the cost approach. This calculates a property's value by adding the land value to the replacement cost of the building, then subtracting any accumulated depreciation. This method works best for newer properties or specialized assets where comparable sales might be limited. Each approach serves different situations, and understanding when to apply each is crucial for accurate property valuation. Here, we're looking at a fundamental concept in investment analysis: the idea that future cash flows are worth less today. This is because money you expect to receive in the future is discounted back to its present value using a required return or discount rate. For example, cash flows of $40,000 in year one, $45,000 in year two, $50,000 in year three, and a larger sum of $320,000 from year four plus a sale are all converted into today's dollars. Discounting takes into account the fact that dollars received later have less value than dollars received sooner, reflecting the opportunity cost of tying up your capital. The net present value, or NPV, is calculated by summing all these present values of future cash flows and then subtracting the initial investment. When the NPV is positive, it means the investment is expected to generate more value than the cost today, which is the core idea behind using this income approach for evaluating income properties. When we talk about acquisition costs and due diligence, there are several critical steps to focus on. First is the inspection. This step is all about confirming the property's structural condition and its systems, as well as identifying any deferred maintenance or immediate repairs needed. Knowing this upfront helps prevent unexpected expenses down the road. Next is the title review. It's essential to identify any liens, easements, ownership issues, or restrictions that could affect your ability to close or use the property as planned. This ensures that the title is clear and there are no hidden surprises. Then we move on to permits. Checking with local authorities to verify any renovations, the occupancy status, and compliance with building codes is crucial. This step helps avoid legal issues and fines that could arise from noncompliance. Finally, there's the environmental assessment. This involves screening for contamination, flood risk, hazardous materials, and any site-specific liabilities. It's important to price the risk associated with these factors before you even look at the potential upside of the investment. By thoroughly addressing each of these areas, you can better manage risks and make more informed investment decisions. Now, let's focus on operating expenses and how they impact the net operating income, or NOI. The core formula here is straightforward. NOI equals gross rent minus operating expenses. This means that to understand how much income a property truly generates, we need to carefully track all the recurring costs. These operating expenses are typically expressed as a percentage of the gross rent. For instance, maintenance usually runs between 5 to 8%, insurance from 1 to 3%, and property taxes can be quite significant, ranging from 8 to 12%. Utilities generally account for 3 to 6%, management fees can be 6 to 10%, and vacancy allowances range from 5 to 8%. When you add all these expense categories together, the typical total operating load falls between 28 and 47% of gross rent. It's important to keep a close eye on these numbers because even small shifts in these percentages can materially affect the property's value and your investment returns. Understanding these components will help you make better informed decisions when analyzing income properties. Now, let's talk about the tax treatment of building costs, specifically focusing on straight-line depreciation. With straight-line depreciation, the cost basis of the building is deducted evenly over its useful life. This method reflects the gradual wear and obsolescence the building experiences over time. One key insight to remember is that depreciation is a non-cash deduction, which means it lowers your taxable income without affecting your actual cash flow. So even if your property is generating positive cash flow, depreciation reduces the amount of taxable income, providing a significant tax advantage. This concept is very important when analyzing real estate investments because it can improve your after-tax return by reducing the tax burden associated with rental income. When we talk about depreciation in real estate, it's important to recognize the difference between residential and commercial properties. Residential rental property is depreciated over 27 and a half years, while commercial property takes longer, 39 years to depreciate. This reflects the typical lifespan and usage patterns of these asset types. Next, consider the distinction between the building and the land it sits on. For tax purposes, only the building itself can be depreciated because land doesn't wear out or lose value in the same way. So when calculating depreciation, you need to separate the value of the land from the value of the building. Finally, there's a difference between capital improvements and routine repairs. Capital improvements, like adding a new roof or remodeling, are depreciated over time, reflecting their long-term value. Routine repairs, on the other hand, such as fixing a leak or painting walls, are usually expensed right away. This distinction is key because it influences both the tax deductions you can take and how your investment's value is calculated over the years. Overall, depreciation mirrors the real physical wear and tear of the property, and tax rules are designed to follow the type of asset you're dealing with. Understanding these types of depreciation helps you better analyze your investment and its income potential. A 1031 exchange allows investors to swap one like-kind real estate property for another while deferring capital gains taxes. There are three key rules to understand here. First, the identify fast rule. Investors have 45 days after selling their original property to identify potential replacement properties. Second, the close on time rule. The purchase of the replacement property must be completed within 180 days to finalize the exchange. Lastly, the real estate only rule. Both the original and replacement properties must be real estate held for investment or business purposes to qualify. These essentials are critical for successfully navigating a 1031 exchange. When it comes to taxation, it's important to understand the difference between ordinary income and capital gains, especially in real estate. Depreciation recapture and short-term gains are usually taxed at higher rates because they fall under ordinary income. This means that any depreciation you claimed in previous years can be taxed back at your regular tax bracket when you sell the property. Additionally, if you hold a property for 1 year or less, the gains are typically treated as ordinary income, which often results in a higher tax burden. On the other hand, holding onto a property for more than a year can unlock long-term capital gains treatment. Long-term capital gains are generally taxed at lower federal rates, providing a more favorable tax environment. This is a key strategy because timing the sale of your investment properly can significantly improve your after-tax returns. In essence, the longer you hold the property, the greater the potential tax benefit, rewarding patience and strategic planning. Understanding these differences is crucial for maximizing your investment income. Rental real estate losses are typically considered passive losses, which means they can generally only be used to offset passive income, not your ordinary income. However, there's an important exception to this rule. If you actively participate in the management of the rental property and your modified adjusted gross income, or AGI, falls below a certain threshold, you may be able to deduct up to $25,000 of those rental losses against your ordinary income. This benefit doesn't last forever, though. It starts to phase out once your AGI hits $100,000 and completely disappears by $150,000. This exception is key to understanding how rental real estate investments can affect your overall tax situation. Let's talk about cost segregation and accelerated depreciation. Instead of treating the entire property as a single asset with one depreciation timeline, we break it down into different components. For example, land improvements like parking lots, landscaping, and site lighting qualify for a shorter depreciation schedule, typically 15 years. Meanwhile, the main building structure follows a longer 39-year commercial depreciation schedule. Why is this important? By identifying these components and shifting eligible costs into shorter life categories, we accelerate depreciation deductions. This means you can reduce your taxable income sooner and improve your cash flow in the near term. Essentially, it's a smart way to maximize tax benefits and make your investment more financially efficient. On this slide, we're focusing on an important distinction in property expenses, repair and maintenance versus improvements. Routine repairs, like fixing a leak or replacing a broken window, are generally deductible in the current tax year because they simply keep the property functioning as it is. However, when it comes to renovations or upgrades that improve or extend the life of property, these costs aren't immediately deductible. Instead, they are capitalized and need to be recovered over time through depreciation. This means that even though you may spend the same amount on the property, the tax treatment can be very different depending on whether the expense is considered maintenance or a capital improvement. Understanding this difference is crucial for correctly managing taxes on income properties and optimizing your investment analysis. Now, let's take a closer look at the various landlord deductions you can claim when managing income properties. First, mortgage interest is often one of the largest deductible expenses, so it's crucial to account for that correctly. Property taxes paid on the rental property are also deductible, helping to reduce your taxable rental income. Insurance costs specifically related to the rental property can be deducted as well, providing further tax relief. Utilities that you pay for as a landlord, whether water, electricity, or gas, can be included in your deductions. Similarly, any repairs needed to maintain the property fall under deductible expenses, but remember these are for repairs, not improvements. Management fees paid to a property manager or management company are deductible too, as are costs associated with advertising your rental to find tenants. Legal and accounting fees that relate directly to your rental activity also qualify as deductions, helping you keep more of your rental income. Understanding these deductions thoroughly is key to effective investment analysis and managing the taxation of income properties. By carefully tracking and claiming these expenses, you can maximize your returns while staying compliant with tax laws. When managing income properties, thorough record keeping and documentation are absolutely essential. This includes keeping all expense receipts organized so you can track every cost related to property. You'll also want to maintain detailed property records and tenant files, which cover leases, deposits, notices, applications, and payment histories. It's important to keep track of repairs, utilities, travel expenses, insurance, and vendor invoices to ensure you have a clear understanding of where your money is going. Additionally, holding on to critical documents like closing statements, loan paperwork, depreciation schedules, and permits is vital for both operational and tax purposes. By staying organized with these documents, you can conduct more accurate investment analyses and navigate the complexities of taxation for your income properties with greater confidence. Let's review the key differences in entity structures for owning investment properties, focusing on liability protection, tax treatment, and self-employment tax implications. Starting with sole proprietorship, there's no liability protection. That means the owner is personally exposed to any risks associated with the property. On the tax side, income typically passes through directly to the owner's Schedule E, and usually rental income is not subject to self-employment tax. Next, the LLC offers strong liability protection. It creates a clear separation between the owner and property risks, which is a big advantage. For taxes, it usually operates as a pass-through entity unless you choose otherwise, and self-employment taxes are generally avoided on passive rental income. Finally, the S corporation also provides liability protection, but requires careful adherence to corporate formalities to maintain that shield. Its tax treatment is passed through as well, but the owner must handle payroll and more complex filings. Here, salary payments can trigger payroll taxes, which is an important consideration. Understanding these differences helps you structure your investment in a way that balances risk, tax efficiency, and administrative requirements. Here we're focusing on leveraging and loan structures, which are essential for stable underwriting and successful property investments. Predictable debt plays a crucial role in supporting underwriting because it provides a clear understanding of payment obligations. Starting with bank financing, this usually offers the lowest cost of capital. Banks provide loans with either fixed or variable interest rates and longer amortization periods, typically ranging from 15 to 30 years. This type of financing works best when the property's cash flow is stable, the borrower's financial qualifications are strong, and there's a clear plan for how long the property will be held. Fixed-rate loans offer payment stability, while variable rates can sometimes offer savings if interest rates remain low. Traditional mortgages fit well with stabilized properties and long-term investments. On the other hand, flexibility can sometimes be more valuable than cost savings, especially in fast-moving deals. Alternative financing options like hard money loans, private loans, and home equity lines of credit, or HELICs, can close faster or help fund properties that banks won't touch. These options tend to be more expensive, but investors lean on them when they need quick access to funds, are planning significant renovations, or require temporary liquidity. Alternative financing is best suited for bridge periods, value-add plans, or opportunistic acquisitions where timing and flexibility are critical. Understanding these options helps tailor financing strategies to your specific investment goals, balancing cost, timing, and risk effectively. Here, we're focusing on three primary exit strategies for income properties: hold, sell, and exchange. Let's start with holding. When you hold a property, you continue to generate cash flow while your equity grows over time, and importantly, taxes on gains are deferred. This strategy supports long-term income and wealth accumulation. Next is a liquidity event, or selling the property. Selling allows you to realize your gains and free up capital that can be reinvested elsewhere. However, this triggers taxes at the time of disposition. So, careful planning is essential to manage the tax impact. Lastly, The exchange strategy involves trading your current property for a new one using a 1031 exchange. This allows you to defer taxes and preserve more of your capital, facilitating continued growth and investment without immediate tax consequences. Each of these strategies has its place depending on your goals, and understanding when and how to use them is critical for effective investment analysis and managing taxation of income properties. When it comes to tax planning for a sale, the key is to minimize your capital gains by being proactive with your strategies before the sale is finalized. The first important point is to plan the sale before you list the property, not after closing. This gives you the flexibility to implement various tax-saving tactics effectively. One crucial strategy is the 1031 exchange timing. You want to identify your replacement property early to avoid the tight deferral deadlines, which could force you into a less favorable acquisition. Planning ahead here ensures you make well-informed decisions and fully benefit from the deferral. Next is cost segregation timing. Accelerating depreciation just before disposition can be beneficial, but only if the immediate tax deductions outweigh the potential risks of future depreciation recapture. So, it needs careful analysis to determine if this approach makes sense for your specific situation. Another tactic is expense acceleration. By pulling forward deductible repairs, fees, and advisory costs into the sale year, you can offset some of the recognized gains and reduce your taxable income for that year. This method can provide significant upfront tax relief. Lastly, consider entity restructuring well in advance. Changes in ownership structure through partnerships, trusts, or LLCs can impact how your sale is taxed. Reviewing this early can help you optimize your tax outcomes and avoid unexpected liabilities. Altogether, these pre-sale tax strategies are crucial to maximizing your benefits and minimizing capital gains tax in the sale of income properties. The key takeaway is to start planning early and work closely with your advisors to tailor these strategies to your specific situation. Here we have a real-world case study focusing on a multifamily residential property. The purchase price for this 24-unit asset was $3.2 million, with cap rate of 6.4%, which indicate a solid return on investment relative to property's value. In terms of income, the annual cash flow amounts to $68,000, providing a steady stream of revenue. Additionally, the first year offers a depreciation benefit of $93,000. This depreciation is a non-cash expense but provides a valuable tax shelter, leading to estimated tax savings of about $31,000. One key takeaway for investors is that multifamily properties like this combine stable net operating income with substantial tax advantages through depreciation. Plus, this particular asset has stabilized occupancy with potential for rent increases, offering both immediate income and growth opportunities. So, the strength of this investment lies not just in strong cash flow, but also in the effective use of tax benefits that enhance overall returns. When small tax errors happen repeatedly, they significantly increase the risk of an audit. It's important to be aware of some common tax mistakes and how to avoid them. First, mixing personal and business expenses can blur what costs are deductible and weaken your defense during an audit. The best way to fix this is by using separate bank accounts and property-only credit cards to keep everything clear and organized. Second, overlooking depreciation means missing out on important annual deductions and understating your after-tax return. To avoid this, set up your depreciation schedule starting from day one. Third, poor record keeping, like missing receipts, can turn perfectly valid deductions into loss opportunities. A good fix is to save all invoices, leases, mileage logs, and repair records digitally for easy access and proof. Finally, ignoring your entity structure can lead to higher taxes and greater liability than necessary. It's crucial to review your LLC, partnership, and ownership setup early to ensure it's optimized for your situation. Keeping these points in mind will help maintain a strong audit defense and maximize your tax benefits. Working with CPAs and tax professionals is essential when dealing with investment properties. Their specialized expertise not only helps you save money through careful tax planning, but also significantly reduces the risk of an audit. They can guide you through complex areas like investment analysis and taxation of income properties, ensuring you comply with regulations while maximizing your returns. Having these experts on your side makes managing your investments much more efficient and secure. When it comes to income property investments, discipline is just as important as the deal itself. First, it's essential to understand cash flow metrics before you even start evaluating potential returns. This gives you a clear picture of the property's financial health. Next, leveraging depreciation can significantly boost your after-tax performance, but only if you plan for it correctly. Speaking of planning, developing your tax strategy early on, rather than waiting until tax season, ensures you're taking advantage of every available opportunity. It's also crucial to document everything meticulously. Doing so helps protect your deductions and the property's basis, which can save you money and headaches down the road. Another important factor is considering your entity's structure carefully, as it influences liability, financing options, and tax outcomes. And finally, when transactions become more complex, don't hesitate to seek professional guidance. The key takeaway here is that strong income property decisions stem from blending investment analysis with thoughtful tax planning right from the start. This integrated approach will set you up for greater success and smoother financial management. Now that we've covered the essentials, let's focus on the next steps for building your investment plan. First, take a close look at your current holdings to understand where you stand. Then, it's crucial to consult a tax advisor before making any major moves to ensure you're optimizing your tax position. Exploring 1031 exchange opportunities can provide significant benefits by deferring taxes when you reinvest in similar properties. Additionally, modeling multiple financing and exit scenarios helps you prepare for different outcomes and make informed decisions. Finally, the goal is to turn this analysis into a repeatable decision framework so you can consistently make smart investment choices. Remember, the key is to plan both the property and the tax outcome effectively.